Good day. Welcome to another session of Fog Accountancy Tutorials. Today we are going to treat a very important topic, which is the final accounts for publication, or what we call published accounts. Now, we know that the company's law require that every public limited company publishes their financial statements for users to have a view and then make decisions based on them. And so we are going to talk about how these accounts are prepared before their publication. Now, we have already dealt with final accounts of sole trader and even basic accounts for companies, and then the final account with a glimpse. But then, what we are going to do here is more advanced than the final account of companies that we have done in the level 1 of our professional exam session or in the lower levels of accounting. What we are going to do here, we are going to do a highly summarized final accounts, which is meant to be published. Now, I'm going to give you the statements that are going to be prepared for a set of final accounts for publication. We are going to talk about the statement of profit or loss and other comprehensive income. All right, so we are going to talk about the statement of profit or loss and other comprehensive income. We are also going to prepare a statement of changes in equity, which is also a statement that is required to be prepared in a set of published accounts. And then also we are going to prepare a statement of financial position, as we know. So statement of changes in equity, changes in shareholders' equity, and then we'll prepare the statement of financial position. Now, these are the three basic statements that we are going to prepare in this video. However, in a complete set of published accounts, there is also a statement of cash flows. And then also there is notes to the financial statement. So for a complete set of accounts for publication, the company must prepare a statement of profit or loss and other comprehensive income to show the profitability and the financial performance of the company. They must also prepare a statement of changes in equity in order to show the movement in stockholders' equity over the period. And then they must also prepare a statement of financial position to reflect liquidity and then other financial positions of the business. And then also there should be a statement of cash flows. But we have already dealt with the statement of cash flows in a different video. Okay, that is being regulated by International Accounting Standard number 7, IAS 7. And so we have already dealt with that. So you can refer to our video on the statement of cash flows, and then you go and look at that. And then we are going to also prepare notes to the financial statements. Now, the notes to the financial statement in the exam setting is what we call the workings. Okay, but the workings must be organized to be very understandable, and so that we call it the notes to the financial statements. Now, these are the sets of accounts that is to be prepared by a public limited company in order to satisfy the legal requirement. However, we in this video are not going to talk about statement of cash flows. And so we are going to talk about the 3 plus the notes to the accounts. Now, the notes to the accounts, like I said, are the workings which you are going to do. And then what I'm going to do in this video is that I'm going to give you the formats and then explain to you some concepts that are very key and important to helping you understand things that are involved in preparation of these statements, okay? And then afterwards, we are going to solve a question in the next video. Kindly bear in mind also that we are going to prepare it for an exam setting, okay? I'm going to teach you so that you use it to write your exam. However, it's the same that you are going to use in the office, but I'm going to be more concerned about exam situation more than an office situation. But nevertheless, I'm going to try to show you what to do in both cases when it's necessary. Other than that, whatever I'm going to say here applies also in the office. All right. And we are going to take them one after the other, okay? And I'm going to begin with the statement of profit or loss and other comprehensive income. And so let me say statement of profit or loss and other comprehensive income for the year ended. So that is how it's headed. Then you bring the accounting year end. Now, what is this statement? This is the statement that you know from ancient accounting to be trading profit or loss account, which has evolved into income statement, which has now evolved into statement of profit or loss. And then we have added something called other comprehensive income. So whatever that you see here is what you know from your normal trading and profit or loss account or the income statement. But now the IFRS requires, or the IAS1, presentation of financial statement, requires that we call it statement of profit or loss and other comprehensive income. I'm going to explain other comprehensive income to you and then the purpose of that in this statement, okay? And so what we are going to do basically is that we are going to do the same things that we do in the trading account. But in this case, it is going to be a highly summarized account. And that is why there is notes to the financial statement. And so almost every figure that you see there will be a summarized figure. And therefore, you need to summarize and show the workings in the notes to the account before you bring it on board. So please watch carefully as I teach you how to prepare the statement of profit or loss and other comprehensive income. Now, let us assume that our currency sign is dollars. And so we show our dollar sign. And then we indicate notes in the account as well. So this is how we are going to present it. We are going to show just one currency sign and then we show notes. Now the purpose of the note is to indicate the note number in the workings that we are going to do in the notes to the financial statement. So for every figure that we bring, if there are any adjustments that are made in the notes, we indicate which note number that we can find that so that we'll go back and refer to how we arrived at that figure. Very, very important. So just like we know that we start with our sales revenue, over here we start with the revenue, okay? So we start with the revenue or the sales revenue for the year. Now the sales revenue will be shown under the currency sign. If there were any adjustments that were made or if there are any workings that we did on the revenue, if it is note 1, we show 1 under the note so that the examiner or whoever is the user of the financial statement, when they pick your financial statement and they look at your sales revenue or your revenue, they will go to the first note and look at what constitutes the total revenue that you have placed on the face of the financial statement. I told you that over here, everything is highly summarized. And that is what we are going to do. So after we've gotten the sales revenue, we know that we less or we take out the cost of sales. And so we show cost of sales in brackets. Now, you see what I have done. If it was a level 1 or the sole trader or the lower levels of accounting, where we are preparing the income statement, when we get to cost of sales, we would have underlined and do the workings down here. We bring the opening inventory, we add the net purchases, we get the cost of goods available for sale, we take out our closing inventory, and then we have the cost of sales. Now, all those things will still be done, but they will be done in the workings. We are not going to show them. I told you that this is a highly summarized statement because the purpose is for publication. You are publishing the accounts either in the graphic or wherever, and you do not want to show the detail of everything on the financial statement. And so according to the IAS1, we show the high summary of the accounts, and then we show workings in the notes. So the notes to the financial statement is to cater for all the workings, how we arrived at the figures on the face of the statement of profit or loss. And so if that was done as workings 2, you write 2 under note on the same line so that when I pick my cost of sales and I want to verify this figure, I'll go into notes 2 and then see how that was derived. Very, very important. Very, very important. And we all know that once you take out your cost of sales from your net sales revenue, you have gross profit or loss. So gross profit or loss will come. Now, so you see how so quickly we have arrived at the gross profit, because it takes only 3 lines: sales revenue less cost of sales, and you arrive at your gross profit. Please and please again, these are things you know already. The only difference is that all the adjustments you would have done on them to make it a longer statement will now be done in the workings, or what we call the notes to the financial statements. Mostly, we know that revenues are affected by a lot of things, returns, and maybe there could be some other adjustments on revenues. This is, I told you, this video is for higher levels of accounting, where you are doing financial reporting at the professional level, ACC or ICAJ, or you are doing it at the master's degree level, or maybe at the final level of a degree program, where you need to present a highly summarized final account for publication. And this is how to go about it. So you please need to pay attention very well as I take you through. So having arrived at your gross profit, the next thing to do, per what we know, is to bring the other income and then take out the expenses. I'm just trying to blend your knowledge of the trading profit and loss account, or what we call the income statement at the lower level, to what we are going to do here. Now, other income, and this is where we need to pay attention and listen. And I'm going to use that to explain other comprehensive income. Now, the other income that is accepted in this statement is the other income that is realized and directly related to the work that a company is doing. There are other incomes that are not accepted, even though at the sole trader level and at the basic company accounts preparation level, we accepted them and added them to other income. And it's inflated our net profit. At this level, we do not accept all incomes as part of incomes that we should use in ascertaining the operating profit, because some incomes are not truly realized. Some incomes are fictions. Some incomes are imaginary. And then some incomes are not directly related to the work we are doing. And so all those incomes that are not realized, that are not supposed to be part of the work we are doing, we call them other comprehensive income. And I'm going to explain it into detail. Now, why other comprehensive income? Look at an example of an income like profits on sale of Ppe. Now, imagine that you have bought Ppe for $400. That is a non-current asset. And then a useful life is, let's say, 5 years. So it means that the annual depreciation charge will be 400 divided by 5. And that will be $80 per annum. So every year you charge depreciation for $80. And then you have used the asset for 3 years. And so accumulated depreciation at the end of the 3rd year will be 80 by 3, which is 240. And so your carrying amount, or your net book value of the asset, will be 400 minus 240. At the end of the 3rd year, you are going to have a carrying amount of $160. Now, remember that depreciation is an accounting estimate. Okay? You are saying that you have used off 80 cedis every year. So in all, you have used off 240 cedis from the value of the asset. But when we come to the company, the asset is there. Nothing has changed. We still see the asset. Okay, the asset is still there. If it's a motor vehicle, we can see it moving up and down. What is the proof that you have parted with 240? Now, you sell the asset to worsen matters. You decide to dispose of the asset for, let's say, $200. And because you are selling it for $200, in your books, you have that you have only the value to be 160. So you take out 160 from $200, and that gives you $40. And you call this profit. And you want to recognize that as part of your income. And that is also going to inflate your net profit. Please, that is not going to give you a true reflection of your operating profit. So this profit is very imaginary, because if you are selling the asset for 200, another person can argue that you sold it for 200, you bought it for 400, you have rather made a loss of 200. And every other person can have a way of estimating their own depreciation charge. And so what we are going to say is that because this profit is debatable, profit on sale of Ppe will rather be classified as other comprehensive income. rather than treating it as business income, because it is a profit that is not truly realized. Okay, we have profits also, other income like gain on revaluation of property. Now, if you are doing revaluation of any asset, gain on revaluation of any PPE or any investment property or whatever it is. Now, if you have a gain on revaluation, that is no cash inflow income. That is no profit realized. So these ones are all classified as other comprehensive income. Then I will explain something that will blow your mind off again when I get to the net profit after tax. Or let's say, let me talk about it for now. Now, listen very carefully. If you include these kind of income items up here in your other income, your business income, before you take out your expenses, you are going to get net profit. Now, in most companies, directors are paid bonuses based on the operating profit. Okay, so if they are to make operating profit of, let's say, 1,000, and it is the company's policy that bonuses are paid 5% on every operating profit they make, then in this case they are going to enjoy $50 of the profit as bonuses. Now, if you include other comprehensive income like revaluation of gain or revaluation of property, you have it to be, let's say, 1,000, and then you have profit on sale of PPE to be, let's say, 2,000, giving you 3,000. If you include that here, then it means that your net profit or your operating profit is going to shoot up from 1,000 to 4,000. And if you calculate 5% on 4,000, you are going to get $200. Now, you see, you are paying bonus on profit that is not real. And you are rather cheating the company. So what we are trying to say is that now let us move all these profits that are not that are not true business profits or that are not realizable. Okay, let us move these profits down and call them other comprehensive income. And so we are not going to include this $3,000 into the operating profit. And that is going to reduce the bonus payment from 200 to 50. So if you include some of these profits up there, you are rather going to deceive yourself as a company that you are making profit. Meanwhile, most of them are just fictional. They are imaginary. They are not real profits. And they are not profits that have been realized. Okay? And so what we are trying to say is that most of these incomes that are other comprehensive income will not be added to your gross profit in the estimation of your operating profit. But rather, what we are going to do is that we rather add other incomes that are truly reflecting and has been realized, and then we will use that to estimate the net profit. After estimating the net profit, we are going to show other comprehensive income, bring all those ones because they should be presented on the financial statement, so that when we add other comprehensive income to the profit, we are going to have a total comprehensive income. So these are the dynamics of what we are going to do. And so gain on revaluation of property, profit on sale of PPE, and even deferred tax adjustment on the gains. It's not all the time that it is profit or a gain. It could be losses also on sale of asset, loss on revaluation. All those ones will be presented in other comprehensive income, except you are solving a question where you are not supposed to do other comprehensive income. I'm sure this is very understandable. Now listen very carefully. If the question requires that you prepare statements of profit or loss and other comprehensive income, then of course these comprehensive incomes must be separated. But if you are solving a question where they did not ask you to do that separation, but they just ask you to prepare statements of profit or loss, and they did not show other comprehensive income as a separate item, then it means that once they are asking you to prepare statements of profit or loss, you may as well bring all of them in there. This is for the purpose of exam. But in real practice of accountancy in our world today, we always try to separate other comprehensive income from incomes that has actually been realized by the business or the company. All right. So I'm going to continue with the format of the statement of profit or loss and other comprehensive income. So right after the gross profit or loss, we add other income. And the other income here, I told you, is the income that is realized. it could be investment income, okay? And it could be, now when you go to organization or company to company specific, there may be differences in what one company will realize at the other income and the other company. But what I'm trying to let you understand is that for exam purposes, what you need to do is that you combine, if it is note 3, you list all your other incomes that you have, and then, I mean the ones that are realized, okay, and then you bring them into the financial statement, and then you show other income, so that you separate that from other comprehensive income. And then you can take out the expenses. Now, in the previous levels, we know that we could have added this, get our total income before we take out the expenses or the operating expenses. Now, over here, we can just put the operating expenses and then we subtract together. Now, operating expenses at this level are grouped into two. We have the administrative and general expenses, and then we have the selling and distribution expenses. Now, no matter the expense that you have, you need to be able to group them under these two. So we are going to take out the administrative and general expenses. Maybe that will be maybe note 4. And then you can also take out your selling and distribution costs or distribution expenses. Maybe note 5. Then you put them in brackets because they are expenses that you are subtracting. Now, what you are going to do is that you need to list all your administrative and general expenses in your workings, maybe note 4. Then you find the total, bring it into the account. You do the same for all expenses that you think fall under the selling and distribution. You bring the total into the account. So you take your calculator, you punch your gross profit plus other income minus the administrative and general expenses minus the distribution cost. And then whatever figure you have here is called your operating profits. Now, the operating profit means that we have taken out operating expenses from operating income. That is why I told you that other comprehensive income is not part of operating income. So you can use that to differentiate incomes that are from operations and incomes that are not from operations. Very, very important. All right. So once you get to the operating profit, now another name for the operating profit usually is the net profit before interest and tax. The net profit before interest and tax. That is the operating profit. So when you get to the net profit before interest and tax, the next thing you have to do is to take out your interest first. So you take out your interest expense. And there could be some workings before you arrive at the interest expense. So if you did some workings as note 6, you put it there, interest expense. And then that will also be shown in brackets because we are subtracting. And once we subtract the interest expense from the net profit before interest and tax, the resultant figure becomes the net profit before tax. So interest is gone. So it's tax. Another name for the interest expense is the finance charges. So sometimes you may see it as a finance charge. Now, once we get to net profit before tax, then we can take out our tax expense for the year. And remember that the tax expense for the year is not all the time easy to come by. So that could be working 7. And I've told you, you need to go back and watch the video on IAS 12, income taxes. Because in the part 2 of that video, I explain how to arrive at this. It is your current tax with this prior adjustment plus the movement in deferred tax. Then that will result in your tax expense for the year. So depending on how the question wants to make it easier or difficult, you need to be able to understand the dynamics of establishing the tax expense for the year. And once you have your tax expense, you subtract the tax expense from net profit before interest and tax, you arrive at your net profit after tax. Then you are done with the statement of profit or loss. So once you have arrived at your net profit after tax, you can now add other comprehensive income, incomes that are not part of operations. So we say other comprehensive income. Now, with the other comprehensive income, The most common ones are what I mentioned: profit or loss on sale of Ppe. So if it is a profit, you are adding. If it is a loss, you are subtracting. Then we can have gain or loss on revaluation of property. That could be a gain or a loss. So let's assume these are the only two. If there is any deferred tax implications, you reduce that also as well. But I'm not going to confuse you for now. We are going to solve a question in the next video concerning this topic, and then we'll be able to understand that better. So once you add your other comprehensive income to your net profit after tax, the final figure is called total comprehensive income. And when you have your total comprehensive income, then you are done with your statement. Statement of profit or loss and other comprehensive. So it's in two parts. The first part is the statement of profit or loss, and the second part is other comprehensive income. So we are done with this. So we are going to move on to prepare the statement of changes in equity. All right. So we are looking at the format for statement of changes in equity. So statement of changes in equity for the year ended. Then you bring the dates. Oh, this is the format. Look at it carefully. I'm sure at this level you know the components of equity. We have the share capital, or what we call the stated capital. We have retained earnings, which we also call income surplus. And then there could be other items of equity like share deals. There could be revaluation or capital surplus. And there could be reserves like the general reserve or any other reserve. And so let us assume that in a question we have these four that I'm going to list. So we leave a space for narration. And then we'll say the first one. So we say the first one, let's say stated capital. We indicate that. And then we leave another space for retained earnings or income surplus. And then capital or revaluation surplus. Capital surplus. And then maybe we have a general reserve. And then we create a column for total. So that's what we are going to do. So these are four items of equity that I'm assuming that we have. And then there will be a column for total. So let me indicate a currency sign as well. In this case, I'm using the dollar sign. Now, this is the outlay of the statement of changes in equity. So we are going to begin with the balance brought forward of all these equity items. It's not all of them that may have an opening balance, take note. But if the business is a going concern, these two will always have the stated capital, and then the income surplus will always have an opening balance. But the capital surplus and the general reserve may not be there. It is this time that they may appear, or they may be there and they may change within the year. So let us take note. So as we are giving from the question, we begin with our balance brought forward for stated capital, for income surplus. If you have some for capital surplus, you show. If you have also for general reserve. And then the total column is there for the additions of all of that. So you add these four on that line, add it horizontally, and then you show that at the total column. When you are done with the opening balances, we are saying it is called statement of changes in shareholders' equity over the year. So we are going to look at how each of these items of equity actually changed within the year. So we are going to pick it in order to make it very easier for us to do. We have to go item by item from left to right, so that by the time we get to the general reserve, we are done with all the changes. So we begin with the stated capital, we analyze changes. Now, go through the question to be sure that if there is anything that actually changed with stated capital within the year. If there is, then you show. Now, stated capital changes could obviously be either an issue of share or maybe a redemption of share. But usually redemptions do not happen. And even issue of shares are rare, but it could happen. So if there is any issue of share, we issued shares for revenue. So that will increase the stated capital. So the value of the additional shares will be added to the opening balance. So that at the end, we have the total share at the end year end. And that is why I'm saying that all these things will change within the year. And as they change, we reflect. Now, if we put it there, we are working on stated capital now. So if issue of shares is changing it, we shift that figure also to the total column. There will be nothing for the others because we are only considering an issue of share where more shares are being bought and money is coming in for capital. Mostly these are the only changes, or this is the only change that will happen with the stated capital. So once we are done with the changes on the stated capital, we move to the income surplus. And please listen, the item that will change the most is the income surplus or the retained earnings because it has a lot to do. And so when we come to the income surplus or the retained earnings, the first thing you need to do is to go and add back the net profit after tax. So we bring net profit after tax. We add the net profit after tax to the income surplus. So it means that this is exclusive of the other comprehensive income. We don't bring that. We bring the net profit after tax. You see that those gain on the revaluation property and all those ones will change the capital surplus. Okay, so if you had brought them in estimation of your net profit after tax, and then you have brought them again to add to equity, capital surplus, you would have done a double counting of the gain on revaluation. So be careful about that. That is why we don't even, it's even another justification why we don't add them to our profit, because they fall under capital surplus. Meanwhile, profits fall under income surplus. So let us know the dynamics of the two. So when we add the net profit after tax, then we can pay out dividend. We know how to prepare income surplus account. So dividends will be paid from the income surplus. So that will make a change. So dividends will be in bracket. In fact, the net profit after tax should also be extended, and the dividends payment should also be extended. The only difference is that the dividends is an outflow, so it's a negative, and then the net profit after tax is an inflow. So we add that to the income surplus. So these are the two basic things that will come in. Then once we are done with these two, we check to see if there is any other thing that will affect the income surplus, like a transfer. We can transfer funds from income surplus to even pay for issue of shares. We can transfer funds to general reserve. We can transfer fund and create another reserve. So income surplus can be used so well. So this dividend payment, I've generalized it. It could be any dividend at all. So please take note, whether interim or final dividend. Now, we can transfer. So we say transfer. Now, the transfers could be either way. It could be that in a particular year, we did not make enough profit. And so the income surplus available may not be able to pay the proposed dividend. But we have enough reserves. So we can transfer money from reserve into income surplus. Also, we can transfer money from income surplus into reserve or into stated capital or to anywhere. So if you are going to transfer from income surplus, what you need to do is to just write the transfer. You are transferring from income surplus, in this case, maybe to the general reserve. So if it is 100 cedis, for example, you put here 100 cedis. Then under general reserve, no, the income surplus should be in brackets because you are transferring out. Then under general reserve, you write the same 100 and it will be positive so that the total will be dash. So what I'm trying to say is that when you add the negative 100 to positive, it gives you a no balance at all. So transfers do not affect the total. That is what I'm trying to let you understand. That transfers do not affect the total. So the account that is given becomes the negative. The account that is receiving becomes the positive. It could have been the other way around. You could have just written transfer and put the negative under general reserve and leave the positive for income surplus. Still, the total column would have been 0. So this means that it's a transfer from general reserve to income surplus, or it could be a transfer from income surplus to the general reserve. All right. And so transfers could also affect the income surplus. This is a transfer to general reserve. So once we are done with income surplus, we go to capital surplus to see if there were some revaluations. And if there was, we just write revaluation. Revaluation under capital surplus, we show it. If it is positive, we show. If it's negative, we put in brackets. And then it will still affect the total column. So remember that the only change that will not affect the total is a transfer, because it is like a raw Peter to pay Paul. Nothing has added up to the money in the equity funds. We are just changing location. Okay, so after revaluation, general reserves do not have much. If it is, they will explain. Most of the time, it's the transfers that affect the reserves. So once we are done with this, assuming these are the changes that we have for the year, then we find the total of each item of equity. So we just add them up. And these total figures that I'm getting now is what we are going to use to prepare the statement of financial position. So please take note. We are going to use, these are closing balances. Okay, these are closing balances to the items of equity. And we are going to use them, each one of them. We pick each total and then we take it to the statement of financial position under the equity column. So once we have understood the changes in equity, the next thing to talk about is the statement of financial position. In fact, I've already spoken about that already, but I need to talk about it again because this is a new video. All right. Okay, so let us finally look at the statement of financial position. We know that the statement of financial position is a reflection of the accounting equation. Assets equals to equity plus liabilities. So that is what we are going to depict. We know that the assets, we have non-current assets plus current assets. So I've just expanded the A. Then I maintain the equity. Of course, we know that the equity has so many elements, so it represents all the changes in equity items. Then the liability can be split into long-term liability and then current liability. So this is going to be the format of the statement of financial position. We'll begin from left to right. After we are done with the non-current asset, we find the current asset to get the total asset. Because of the equal sign, we rule off. Then we begin equity and liabilities to the end. And that is the format of the statement of financial position. So we are going to begin statement of financial position. Assets. Statement of financial position, assets. Then you bring the date. So the same way you show your currency sign, if it's in dollars, then you say notes. So the notes to the account will also appear here. So you begin with your non-current assets, just as I have shown you here. Non-current assets. Non-current assets. Now, under the non-current assets, we have our property, plant, and equipment, which is our PPE. Of course, you can ascertain this by preparing the PPE schedule. The PPE schedule. Of course, the PPE schedule, how to prepare the PPE schedule, I'm going to teach that right away after this video as a part 3 to IAS 16. So please, you need to look at that as well. You can use other means to ascertain the PPE value, but please, it is important that you prepare the PPE schedule. It is very simple, well organized, and gives you some extra marks. So that is the PPE figure. So you need to, if you have motor vehicle, land, building, you need to accumulate, you need to do workings and get just one figure. We are not supposed to list non-current assets here like we do for sole trader and other levels. So that we come and put motor vehicles, equipment, plant, machine. No, we don't do that. All of them fall under PPE. So you prepare your PPE schedule nicely, get your final figure, and then you show that as property, plant, and equipment. If you have any investment property, you show that as well. If you had to, so this could be, PPE could be, let's say, working 9, so note 9. If you have any workings on investment property, you show the note as well. If you have any other intangibles, so intangible assets, intangible non-current assets, under IAS 38, you show that as well. So you see, over here, you are highly summarizing everything. So all your PPE will show your investment property. If you have any intangible non-current asset, you show that as well. Then your total, you put one underline as total non-current asset. Then afterwards, you show your current assets. Under the current assets, you have your inventories. You arrange them according to liquidity. So inventories, If you are any workings on that, you show. Then your trade receivables. If you have other receivables, you can show. All right. And then you can have your cash and cash equivalents as well, which may include, the other receivables may include prepayments and accruals. So please take note. And then it may include other short-term investments as well. So once you have your current assets, you also find your total for that. So now total of the non-current assets plus your total current assets gives you, let me call it BBB. That is my total assets. So I am done with one side of the accounting equation. So I can move on to the other side. So I'll call it equity and liabilities. Under equity and liabilities, I'll begin first with my equity. So what I'm going to do is I'm going to show the equity items that I use to prepare the changes in equity. So I will show each of them individually. So stated capital will be shown. This will be the closing balance that I got from the statement of changes in equity. If there is any, yes, and then I also show the income surplus as well. And then capital surplus, and then general reserve. So I have the total for equity. When I have the total for equity, then I move on to long-term liability. So look at what I did. We are moving from left to right. So from equity, we move on to the long-term liabilities and then the current liabilities. All right. So I write my long-term liabilities or my non-current liabilities. So for a company account setting, so the notes still appears. So I can have the something like loans, preference shares, debentures, and maybe some bonds. If they are separate, you separate them. I'm just trying to summarize it for you. So you show all your long-term liabilities. If you have any deferred tax liability, you show that as well. So you add up all your long-term or your non-current liabilities. You put the total, you just show one underline. And then afterwards, you look at your current liabilities. These are items you are very familiar with, most of you. And so that is why I'm doing a quick recap of them. So after your current liabilities, you list them. So you have trade and other payables. So trade payables, you could show them. If you have other payables, accruals, prepayments, you show. Then there could be a lot of other current liabilities that you may not have come across, like income tax. So taxation, tax payable is a liability. You can have interest payable as well. And then you can have dividend payable as well. So you show your current liabilities, as many as you can find. You show the total for that. Then finally, you add up your equity plus long-term liability plus current liability, and that is going to give you BBB, just as I have here. And we call that total equity and liabilities. Then you are done. So this is how to go by the statement of financial position. Okay. So this brings us to the end of our first video on published accounts or final accounts for publication. Now, in our next video, we are going to take a question and we are going to solve it together so that it will enhance our understanding. But before that, I'm going to treat the property, plant, and equipment schedule that I said, the PPE schedule, and I'm going to upload it also so that you'll be able to refer to that and then use that, because in our solution to the question, we'll use the PPE schedule. So I have to teach that before we upload that video as well. Remember to subscribe to this channel if this is your first time. share this video, and let others also have a benefit. And until we meet again another time for the part 2, it is bye for now.